There's a business deal announced in September that caused one person's net worth to increase by over $100 billion in a single day, the largest one-day wealth jump ever recorded in financial history. Not gradually over months as a company's stock climbed, but in roughly 24 hours following a single contract announcement. The person who experienced this unprecedented wealth surge wasn't Sam Altman, despite OpenAI being valued at astronomical levels. It wasn't Jensen Huang, even though NVIDIA's chips power nearly every AI system. It wasn't even Mark Zuckerberg, whose Meta has invested tens of billions into AI infrastructure. It was Larry Ellison, the co-founder of Oracle, a company that doesn't build AI models, doesn't manufacture the processors that power them, and until recently was considered a legacy enterprise software company stuck in previous technology generations.
The contract that triggered this wealth explosion was between OpenAI and Oracle, a $300 billion agreement for cloud infrastructure services extending through the end of the decade. But here's what makes this particularly interesting. Oracle isn't the dominant cloud provider. Amazon Web Services controls roughly a third of the cloud market. Microsoft Azure holds another significant chunk. Oracle has been a distant player in cloud computing, often dismissed as playing catch-up in a race it entered years too late. So how did this legacy database company position itself to become the infrastructure provider for what might be the most valuable AI companies? And why did this contract generate such an unprecedented wealth impact? The answer reveals a pattern about technology industry evolution that's both counterintuitive and instructive. Sometimes missing one technological revolution completely can teach lessons that position you perfectly for the next one. What follows is an examination of how Oracle went from dismissing cloud computing as meaningless buzzwords to becoming the infrastructure backbone for frontier AI development, and what this trajectory suggests about the economic realities underlying the current AI investment surge, the equity structure that amplifies everything. Before understanding how Oracle positioned itself strategically, it's worth understanding why the financial impact of that positioning hit Larry Ellison so dramatically. The mechanism is straightforward. Ownership percentage. When a company's valuation increases, that increase flows proportionally to whoever owns equity in that company. Jensen Huang, despite founding NVIDIA and leading it to become one of the world's most valuable companies, owns approximately 3% of the company. That's still enough to make him one of the world's wealthiest individuals, but it means 97% of NVIDIA's value appreciation flows to other shareholders. Mark Zuckerberg owns roughly 13% of Meta, an impressive ownership stake for a founder of a company that size, and one that's made him extraordinarily wealthy as Meta's valuation has climbed. But Larry Ellison still owns 42% of Oracle. When Oracle's stock price surges, nearly half of that value increase goes directly to him. This ownership structure is unusual for a company of Oracle's scale and age. Most founders who take companies public see their ownership stake diluted substantially over decades as the company issues new shares for acquisitions, employee compensation, and other purposes. Ellison maintained this concentrated ownership through a combination of factors, including Oracle's capital structure, his resistance to dilutive acquisitions, and frankly, his negotiating position as both founder and longtime chairman. The practical effect is that Oracle's success or failure impacts his personal net worth more dramatically than most founder CEOs experience at mature companies. But there's a crucial caveat about that $100 billion wealth increase. It's paper wealth based on stock valuation, and the contract driving Oracle's stock surge isn't cash in hand. The $300 billion OpenAI agreement is structured as RPO, remaining performance obligations. It represents contracted future revenue, not immediate payment. The deal extends over 5 years beginning in 2027, meaning Oracle must deliver services over time to realize that revenue, and OpenAI must have the funding to pay for those services as they're consumed. This structure carries substantial risk. If OpenAI's business model doesn't generate enough revenue to sustain the level of compute usage this contract anticipates, the projected revenue might not materialize. Analysts expect Oracle to run negative cash flow for years as they build the infrastructure capacity required to deliver on these commitments before seeing the payoff. They'll need to provision approximately 4.5 gigawatts of power capacity, more electricity than 2 Hoover dams generate, enough to power roughly 4 million homes. The cloud computing dismissal that aged poorly. To understand Oracle's current position, you need to understand where they came from and what they almost missed entirely. Oracle was founded in the 1970s, providing SQL database systems, software that companies would license and run on their own servers, with Oracle providing support and updates. This model worked extremely well for decades. Oracle grew steadily, went public, expanded into adjacent enterprise software categories, and became a dominant force in enterprise IT. Then in the mid-2000s, a fundamental shift began that Oracle initially dismissed entirely. Amazon, primarily known as an online retailer, launched Amazon Web Services in 2006, offering computing power, storage, and various IT services, delivered remotely rather than installed on customers' premises. The cloud computing model represented a fundamental change from Oracle's traditional business. Instead of selling software licenses for customers to run themselves, cloud providers operated massive data centers and sold access to that infrastructure as a service. Larry Ellison's initial reaction to cloud computing is now infamous. In 2008, he gave interviews dismissing the entire concept as meaningless buzzwords and fashion-driven hype with no substance. He questioned what cloud computing even meant, suggesting it was gibberish, and wondering when the idiocy would stop. In fairness to Ellison's skepticism, technology industries do generate substantial hype around concepts that ultimately prove less revolutionary than promoted. But in this case, his skepticism proved badly mistaken. The wake-up call came through financial results. AWS broke even around 2009, then became increasingly lucrative with revenue roughly doubling year after year. Despite generating only a fraction of Amazon's total revenue, AWS produced twice the operating profit of Amazon's massive retail operations. The margins on cloud services proved substantially better than the low-margin retail business, and customer adoption accelerated as enterprises recognized the advantages of pay-as-you-go infrastructure over large capital investments in their own data centers. By the time Oracle launched their cloud offering in 2012, they were years behind. AWS revenue was exploding, from $4.6 billion in 2014 to $12.2 billion just 2 years later, while Oracle's revenue remained essentially flat. In terms of cloud market share, Oracle was a distant also-ran compared to AWS, Microsoft Azure, and even Google Cloud. The strategic pivot that changed everything. In 2014, Larry Ellison made what appeared to be a retreat. He stepped down as CEO, but the move was more nuanced than simple resignation. He remained executive chairman, meaning he retained ultimate authority over corporate direction, and took the title of Chief Technology Officer, focusing specifically on product and technology strategy rather than day-to-day operational management. Two co-CEOs handled operational execution, while Ellison concentrated on positioning Oracle for future technology waves. Oracle invested over $5 billion in cloud infrastructure R&D, but rather than trying to directly compete with AWS on general-purpose cloud services for every possible workload, they made a strategic bet on a specific emerging category: high-performance computing for AI and machine learning workloads. In 2018, they launched what they called Gen 2 Cloud, with a focus on bare metal infrastructure, optimized for performance-sensitive workloads such as artificial intelligence or engineering simulation. The 2018 press releases specifically highlighted integration with NVIDIA GPUs for neural network training, the architectural foundation of large language models like ChatGPT, which wouldn't capture mainstream attention until 2022. Oracle was building infrastructure specifically optimized for AI training workloads years before the current AI surge made such infrastructure extraordinarily valuable. This positioning wasn't about predicting that ChatGPT specifically would explode in popularity. It was recognizing that machine learning and AI represented computing workloads with specific infrastructure requirements, massive parallel processing capability, high bandwidth networking between compute nodes, specialized cooling for GPU clusters that differed from general-purpose cloud computing. By optimizing for those specific requirements rather than trying to compete on general-purpose cloud services where they were hopelessly behind, Oracle carved out a niche that became extraordinarily valuable once frontier AI labs needed infrastructure at unprecedented scale. The economics that don't quite add up yet. The OpenAI-Oracle deal and similar contracts with Meta and other AI companies represent an extraordinary bet on a future that hasn't fully materialized yet. The $300 billion contract assumes OpenAI will consume that much infrastructure over the contract period, which requires OpenAI's business to generate sufficient revenue to fund that level of compute usage. Given that OpenAI currently operates at substantial losses despite charging for ChatGPT access, this is hardly guaranteed. The broader AI investment landscape has become almost surreal in scale. In the first half of 2025 alone, AI startups raised $44 billion, more than the entirety of 2024. Goldman Sachs estimates total AI investments reaching $200 billion. Morgan Stanley projects nearly $3 trillion in global data center spending through 2028. NVIDIA announced $500 billion in investment for AI factories, not chip fabrication facilities, but massive compute clusters for running AI models. These numbers are staggering, but they rest on assumptions about AI's economic value that remain largely unproven. Research from MIT found that most AI integrations don't generate rapid revenue acceleration. Only about 5% do. The successful cases tend to be startups that identify a specific problem, build a focused solution, and execute efficiently. Large enterprises trying to integrate AI into existing workflows have struggled more than the hype suggests. Some high-profile examples are instructive. Companies like Klarna, that announced they were replacing customer service workers with AI, are now quietly hiring humans back. IBM laid off thousands of workers expecting AI to fill the gap, then began rehiring because the replacement didn't work as anticipated. The gap between AI's capabilities in controlled demonstrations and its practical utility in complex enterprise environments remains substantial. Financial analysts have pointed out the economic absurdity implied by current AI valuations. For the investment levels to make sense, the top technology companies would collectively need to add roughly $600 billion in annual revenue, equivalent to each of them adding an entire Walmart to their existing business. That's a level of value creation that would require AI to fundamentally transform nearly every aspect of the global economy. Even Sam Altman acknowledged in August that investors as a whole are probably overexcited about AI, a remarkable admission from someone leading a company valued at astronomical levels based on AI expectations. The same person making this observation had just signed a $300 billion infrastructure contract with Oracle, the contradiction at the heart of AI economics. So we're left with a strange contradiction. AI appears simultaneously overvalued based on current practical utility and undervalued based on theoretical potential if the technology achieves what proponents believe it will. Current AI systems demonstrably have limitations. They hallucinate information, struggle with complex reasoning, can't reliably handle many enterprise workflows, and consume extraordinary computational resources relative to the value they generate. These limitations suggest current valuations are excessive. But it's also true that AI capabilities have improved dramatically just over the past few years, that research continues advancing rapidly, and that historical technology revolutions consistently exceeded what seemed plausible during their early phases. If AI development continues its current trajectory, systems 5 or 10 years from now might justify investment levels that seem absurd based on 2025 capabilities. So here's where Oracle's story stands. A company that completely missed the cloud computing revolution by dismissing it as meaningless buzzwords, spent years playing catch-up, then made a strategic bet on AI-optimized infrastructure before large language models captured mainstream attention. That positioning resulted in a $300 billion contract with OpenAI and the largest single-day wealth increase ever recorded when markets reacted to the deal's announcement. Larry Ellison's 42% ownership stake amplified Oracle's success into unprecedented personal wealth impact. But that wealth remains largely paper value, dependent on OpenAI and other AI companies actually consuming the infrastructure levels these contracts anticipate, which requires their businesses to generate revenue that currently doesn't exist at the necessary scale. Oracle must build massive infrastructure capacity, running negative cash flow for years before potentially seeing returns.
The broader AI investment landscape has reached levels that seem disconnected from current practical utility, with hundreds of billions flowing into companies and infrastructure based on expectations that AI will transform nearly everything. Some of that investment will undoubtedly pay off spectacularly. Some will prove to be enthusiasm exceeding reality. Whether Oracle's specific bet proves brilliant or premature won't be clear for years. But regardless of ultimate outcomes, the company's journey from cloud computing skeptic to AI infrastructure provider demonstrates how missing one technology wave entirely can, if properly learned from, position you for the next one. Sometimes the most valuable lesson is recognizing when you were catastrophically wrong.